Vietnam, the next China. As wages rise in China, many firms are shifting production to Vietnam, where labor costs are cheaper. In this video, we will look at the comparative advantage of China and Vietnam, and the impact on different groups of people. In Vietnam, the workers' wages are only about a third of a China worker's wages, making it cheaper to hire a Vietnam worker. The cost of land use is also lower in Vietnam than in China. However, China has better infrastructure, making the transportation of goods easier, hence more efficient. On the other hand, Vietnam's infrastructure is poor, causing the transportation of goods to be less efficient. China has a more skilled labor force than Vietnam, hence productivity in China is higher. Vietnam has revised much of its laws, causing foreign investors to worry about switching from China to Vietnam, as they are not familiar with the laws there. Despite the wage rise in China, there are still other areas of China with low wages, where the foreign company can move to. When comparing both countries, China has the upper hand, hence there will still be more foreign investors going into China than Vietnam. However, in the long run, it could be Vietnam. As time passes, Vietnam can improve itself by training its workforce and building more roads for better infrastructure. When MNCs move from China to Vietnam, there will be an increase in demand for labor by these companies. The expansion of the market and large-scale production creates more job opportunities for its people, which decrease their unemployment rate. Since aggregate demand equals to C plus I plus G plus X minus M, when investments increases, AD curve shifts upwards from AD0 to AD1. The level of national income is raised from Y0 to Y1. The movement of production to Vietnam to produce exports has allowed Vietnam to improve her economy by an export-led growth. This drives up wages. Hence, people in Vietnam are able to enjoy a higher standard of living. For the producers, moving to Vietnam would mean a cheaper land and labor cost. Thus producers are able to produce more with the same amount of resources. For example, the cost of labor in China is about 4 times that of Vietnam. This benefits the producers, as the lower cost of production improves the firm's export competitiveness.
Regional economic integration between Vietnam and ASEAN can expand global markets and is advantageous for Vietnam economy, as free trade agreement decreases the tariff on Vietnam's exports. Exports will become cheaper and quantity demand will increase. When quantity demanded increases, businessmen in Vietnam seize this as an opportunity to venture into the export industry, hence creating opportunity for Vietnamese business to expand. The increase in quantity demanded for Vietnam's exports will also increase the demand for labor to produce those exports. This will create jobs opportunity, improving the unemployment rate in Vietnam. Besides exporting goods abroad, trade allows goods to be imported into Vietnam. When tariffs on imports is lowered, the cheaper imports increases consumer surplus and can also improve the society's welfare. When imports makes up a large proportion of goods in Vietnam, locals can enjoy a wider range of goods and thus satisfy more wants of the locals.